Hello, my name's Rachel and welcome back to my channel. So in today's video, I will be talking you through 4 key principles that Vanguard thinks you should be doing to be a successful investor. So I already own the Little Book of Common Sense Investing by John C. Bogle, who is Vanguard's founder. And then more recently, I have been reading some of Vanguard's research and their papers. So I've taken some really important information on investing from one of their papers that I'm going to share with you today. And I'm also going to talk you through how this changed my mindset on investing and made me make some little tweaks to my investments to hopefully be a more successful investor. As I think transparency is key, I think it's really important to let you know that I currently hold 2 Vanguard investments in my investment portfolio, but the majority of my investment ISA and my self-invested personal pension is invested in funds and trusts and ETFs outside of the Vanguard platform. However, I do think after reading through this research paper that actually there is a lot that I can be taking from Vanguard. Vanguard has an amazing reputation, they have some really low cost index fees, and they also do some brilliant research. So although I'm not heavily invested in Vanguard myself, there are definitely some key points that I will be taking from this paper. Also, just to say, I will link the PDF from Vanguard's website down below, just in case you want to have a little look at it in more detail. So first of all, coming in at number 1, we have goals. So Vanguard want you to create some clear and appropriate investment goals before you start investing. So Vanguard says an appropriate investment goal should be measurable and attainable. Success should not depend on outsized investment returns, nor upon impractical saving or spending requirements. So I think first and foremost, Vanguard want you to be really realistic when you're coming up with your investment objectives and your investment plan. They've included a basic framework for an investment plan in this paper, so I just thought I'd share that with you as well. So they've got a very clear objective here of saving $1 million for retirement adjusted for inflation. They also then go on to list any constraints that there might be, saving or spending targets, so willing to contribute $5,000 in the first year is their saving target. Then asset allocation targets, they want to have 70% allocated to diversified stock funds and 30% allocated to diversified bond funds. Then it goes on to say that they will rebalance this portfolio annually. So this is something I am going to sit down and do for myself, because when I first started investing, what I did is basically put as much money as I possibly could into a diversified investment portfolio. And that was it. There wasn't a plan beyond that. I know that I would like to retire by the time I'm 55. I know that I would like to have a nest egg saved for my children for when they turn 18, but I haven't got these clear goals written down. And I think that sitting down and working through my objectives, my goals, will really help me to get excited about investing and potentially push it a little bit further. I also want to add a timeline for these goals. So obviously, for my children, I want to be able to give them some money when they turn 18. However, for you, you might have a shorter term investing target. Generally, it's advised that you should be investing for at least 5 years as a minimum. So say, for example, you are looking to save a deposit for a house, it might be worth considering investing some of that money if you are not looking to buy that house in the next 5 years. So for me personally, it took 8 years to save a deposit for a house. I thought it was going to happen a lot quicker than that. I definitely overestimated how much I'd be able to save for buying my first house, particularly because I was paying rent at the time. So for me personally, looking back, I wish I had invested some of that money and seen it grow much faster rather than doing what I was doing, which was just holding it in premium bonds and high interest savings accounts. However, if you're looking to buy a house in the next couple of years, then potentially investing isn't for you because it can be very volatile and you would need to be able to ride out any dips in the market. So if you'd like to see my updated framework for my investment plan in the style of this Vanguard framework, then please do subscribe, because I will be sharing on this channel in the next couple of weeks. I'll also be sharing a spreadsheet which I'm putting together with much more detail around how I plan to get to these goals, because for me personally, I like to see progress. I like to have specific monetary values against things. So yeah, I will be sharing that in the next couple of weeks. So please do subscribe if you fancy seeing that. So the next key principle that Vanguard has included in this paper is minimizing costs. They have got a fantastic quote on this which says, "Markets are unpredictable, costs are forever. The lower your costs, the greater your share of an investment's return." And then I'm going to include straight away this nice illustration of the impact of costs. So this is the long-term impact of investment costs on portfolio balances. Assuming a starting balance of $100,000 and a yearly return of 6%, which is reinvested. So before costs, you'd have $574,349. After a 0.25% cost, you would have $532,899. And then after a 0.62% cost, you would have $477,141. So obviously you can see there is a huge amount of difference in the value of that money after 30 years of investing if you end up paying high platform fees or ongoing charges. So when you start investing, it's really important to look through all of the different investment options that are available to you, the different platforms that are available. Really important to consider cost. As long as that platform is right for you, it has the investments that you want to make, cost should probably be the thing that you are looking at next. Also, if you've already got, say for example, a SIP or an investment ISA set up, it can seem a bit of a faff to go through, transfer that to a different, cheaper provider when you've already established a relationship with your existing provider and you're happy with them. However, when you think about the massive amount of difference in the money that you are left with at the end, so I am personally changing my self-invested personal pension platform because when I was going through and reviewing self-invested personal pensions, I realised that the percentage fee was really good for this platform. However, there was an additional admin charge which was making it basically double the price and much more expensive. So I'm in the process of transferring my pension at the moment to a different provider. So yes, it is a bit of a faff. It's going to take some time. It'll probably take around about a month to move those investments over. I've got to fill in some forms, but I definitely think it is worth it, particularly because this is for my self-invested personal pension, which I won't be taking out for over 20 years. So the next key principle that Vanguard talks about is discipline. Now this one is really, really important, and if I'm completely honest, it was something that I struggled with when I started investing. So Vanguard says that you should maintain perspective and long-term discipline. Investing can provoke strong emotions. In the face of market turmoil, some investors may find themselves making impulsive decisions or, conversely, becoming paralyzed, unable to implement an investment strategy or rebalance a portfolio as needed. So as I've been investing for a few years now, I do think that my discipline has got much better. I made a video recently about how I don't sell my investments when it looks like the market is crashing or falling or dipping. I do tend to hold on to them. So I think I'm good at holding on to investments in a volatile market. I think I've also learned that I do not have the ability to time the market, and very few people actually do. So for me personally, I don't try and buy the dip. I simply buy when I have the money to buy investments. And if I have a lump sum to invest, I'll invest it there and then. Or if I don't have a lump sum and I can only save money that I've made every month, then I will invest that on a monthly basis. I simply invest when I can. However, there is an area of discipline that I do think I have been neglecting, and this is the rebalancing the portfolio side of things. This is something, to be honest, I haven't really done a lot of. My portfolio tends to just be funds, trusts and ETFs. I don't have any bonds at the moment, so I don't need to rebalance in that way. However, some of the funds that I'm invested in have done particularly well. For example, the Bailey Gifford American Fund that I was invested in went up over 100% in 1 year when I was invested in it. So because of that, that makes up a large proportion of my portfolio, and rather than potentially just holding on to all of that, maybe I should look at redistributing that into some different investments. So I think I'm going to add it as one of my goals to rebalance my portfolio every single year and check that I am happy with the quantities of certain funds, ETFs and trusts I'm holding. And then when I eventually do add some bonds into my portfolio, potentially when I'm a bit older, making sure that the allocation of bonds is right for me as well. And then the final point that they go into some detail on is balance. So having a really balanced portfolio. It says a sound investment strategy starts with an asset allocation suitable for the portfolio's objective. Both asset allocation and diversification are rooted in the idea of balance. Realistic return assumptions, not hopes, are essential in choosing an allocation. So, for example, over the history of the capital markets since 1926, the US stock returned an average of 10.3% annually, and US bonds returned 5.3%. For this 93-year period, a half stock, half bond portfolio would have returned 8.3%. They then go on to say diversity is a powerful strategy for managing risk. Diversifying across asset classes reduces a portfolio's exposure to risks associated with a particular company, sector or segment. And this is something I'm personally trying to work on at the moment. My portfolio is very, very tech heavy. It's also got a focus on growth, stocks and funds and trusts. So realistically, I'm thinking that I do need to have a look at some value stocks and some value investments, as well as choosing some investments that are outside of that tech sector. So this is something I'm going to be working on in the next few weeks and months. And then I think this is a really strong point to end on. So Vanguard says, although a broad market diversification cannot ensure an investor against loss, it can help to guard against unnecessarily large losses. One example in 2008, which is obviously when the stock market crashed, the S&P 500 index returned a minus 37%. Ugh. However, more than a third of the stocks in the index that year had individual returns of worse than minus 50%. Some of the worst performers in the index would probably have been viewed as blue chip companies not long before. So being invested in the S&P 500 as a whole, rather than just being invested in a small amount of companies, so having more diversity, yes, in 2008, the S&P 500 did lose minus 37%. However, there were some companies in there that had lost minus 50%. And were you holding those individual companies, it wouldn't have been a great year for your investments. So overall, reading this paper has definitely made me sit down and have a think about my portfolio and the changes that I want to make. So I'm going to be making these changes over the coming weeks and months to my portfolio, and then hopefully I will end up with some really clear goals and objectives for my investment portfolio, which I think will really help me to keep excited about investing and essentially be a better investor. Thank you so much for taking the time to watch, and I hope you have a lovely day. Bye bye.